we are getting details on the Federal Reserve minutes from the last meeting. It looks like most Fed officials in July saw conditions for a rate rise. We're getting these headlines out early, and I brought Mike McKee on set here with us to explain what are we seeing in these notes, or at least in the headlines?
Well, it's all about inflation now. When Federal Reserve officials met 3 weeks ago, they said most judged, according to the minutes, that the conditions for policy firming had not yet been achieved, but they noted the conditions were approaching that point. What was missing? Well, confidence that inflation would continue to rise towards its target. Some members continued, it says, to see downside risks to inflation from the possibility of further dollar appreciation and declines in commodity prices. And remember, this was before the latest leg down in oil prices. In addition, several noted that higher rates of resource utilization, in other words, tighter labor markets, weren't pushing up wages, weren't creating inflation pressures at the time. They agreed to continue to monitor inflation developments closely, and here's the key quote, with almost all members indicating they would need to see more evidence that economic growth was sufficiently strong and labor market conditions had firmed enough for them to feel confident inflation would move to the 2% target. Now, again, this was 3 weeks ago, before what happened with jobs, what happened with prices, oil, and China. At the time, some emphasized the economy had made significant progress over the past few years, viewing the economic conditions for beginning to increase the target rate for federal funds as having been met, or they were confident they would be met shortly. They generally agreed they needed additional information on the outlook, but one member was willing to raise rates. Doesn't say whom. A lot of people thought it might be Jeffrey Lacker. He did not dissent.
In July.
In July.
Yeah.
A couple others thought that waiting might put them behind the curve on inflation, affect financial stability, and others said, well, you know, if we raise rates sooner rather than later, it's going to add to people's confidence about the economy because they'll see that we are confident in the economy. So a mixed picture, but a little more concern about the inflation outlook, again, before another leg down in oil prices and what happened with China.
That's right. In fact, I see headlines here. Ben Willis sending me a headline from Princeton Securities that there were a number of participants who had already expressed concerns about China, and this was, of course, before the devaluation of the yuan.
They had talked about the possibility of international developments hurting the U.S. economy, and at that time they were talking about the Chinese stock market crash. And that, of course, they put a floor underneath, except for the last couple of days, but then we moved on to the devaluation of the yuan.
Right.
And the whole thing comes back to how it affects the dollar and whether the dollar holds down exports in this country.
So on the overall, it doesn't look like the Federal Reserve is terribly worried about incredible dollar strength, or at least that's not one of their main twin mandates, so they don't express that so much.
So what they're worried about is that inflation rise enough and job creation continues strongly. If the economy weakens, that won't happen. And what they're worried about, or what they are at least talking about, is the possibility that a stronger dollar would weaken the economy. And again, this is 3 weeks ago. They're data dependent. They have another month to go before the next Fed meeting. So they've got plenty of time to see some sort of turn, to see the dollar either firm or to see oil prices stop falling and maybe stabilize. Those sorts of things can happen. Plus, on top of that, we get the jobs report in September that'll probably be very determinant.
All right, so we got, what did we get this morning? PPI at
CPI this morning.
CPI, sorry, at a gain of 0.1%. We were looking for 0.2%, the month-over-month number. What about the other data? Like, what have we seen since these minutes, you mentioned 3 weeks ago, to encourage the Fed to stick to the course of raising rates in September? Well,
essentially a mixed picture. On the jobs mandate, obviously things were good. We saw a good jobs report for the month of July at the beginning of this month, with unemployment staying at 5.3% and over 200,000 jobs created. Once again, all indications are we'll probably see something similar for the month of August when the numbers come out on September 4th. We've seen better manufacturing numbers. We've seen better housing numbers. Retail sales have been a little bit better, but the confidence numbers have been lower. And even during this meeting, they discussed the fact that business investment has not been strong. So there are some mixed views on the economy in general. It seems to be stronger, not as strong as they would like. And they're going to wait till the last minute probably to make a decision.
Will this affect, I mean, most economists that we speak to still expect the Fed to increase rates in September, whereas futures show more of a mixed picture. Will these minutes change do you think, what economists are thinking out there as far as the schedule?
Probably won't change what economists are thinking because they're going to sit back like the Fed and wait for the data. The markets might move a little bit in the direction of a delay based on these minutes because of the concerns about inflation coming on the back of a weaker than expected CPI report. So you could see Fed funds futures pull back a little bit and maybe go under 50% now. But it really is all kind of meaningless, the guessing game about what the Fed's going to do, because they do have this month to go and they could change their minds based on any number of data. Suppose we get 300,000 jobs, suppose we get 100,000 jobs, it's going to change everybody's perception.